Welcome to Lord and Richards Radio, a program that will enable you to become more financially independent and prosperous from a biblical point of view. Tune in each week to learn how to prosper through good markets and bad. Now, here's our host, Colin Richards, your biblical investment advisor.
Hi, friends. I'm glad to be with you today on Lord and Richards Radio. I'm Colin Richards, founder and president of Lord and Richards. We're a team of advisors who are dedicated to helping people just like you retire financially independent. And we're doing that every single day. On this show, we're discussing investing and planning from the perspective of key biblical principles, a little bit different way of looking at money. We also talk about how to use methods and strategies that will enable you to prosper through both up and down markets. And that's so important in today's volatile world. I'd love to chat with you. My team and I would love to help you, talk to you about your specific questions regarding retirement and saving and investing from a biblical point of view. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400. I'd love to chat with you about how you can achieve financial independence from a biblical point of view. Or just check us out on the web at lordandrichards.com. Hi, friends. This is Colin Richards, president and founder of Lord and Richards. And once again, I'm thrilled to be with you on this edition of the Lord and Richards Show. And today we're going to address geopolitical instability. As you know, our global climate right now is one of war. And as the Bible predicts, we live in a season that's really been going on for a long time of wars and rumors of wars, conflicts abroad. Thank goodness for us as Americans, we're not seeing conflict here at home, troops on the ground in our country, but we are seeing conflict globally, and it continues. It continues day and night. At times, the U.S. is involved. At times, we're not. But trust me, it's always affecting us. And so one of the questions I frequently get is, hey, Colin, with all this instability, wars, geopolitical problems, should I be concerned about how we're invested and our financial plan? And what I always want to remind the folks that work together with us here at Lord and Richards is, first of all, we've built and designed a plan that is built around geopolitical instability, built around market drops and catastrophes, built around great recessions and depressions. We, at the time that we first begin meeting with you, start talking to you about the potential impact of these things. Whether we're going through them at the time or not, we expect you to go through them. Why is that? Well, most of us, if we retire when we're hoping to, maybe in our early or mid or late 60s, we're hoping for 20, 25, 30 years of retirement. Well, that's a big chunk of time. That's a big chunk of history. And we look back over time here, even in the relatively stable economic and political climate that we enjoy in the U.S. relative to the rest of the world, most of it, we still have seasons of instability, unpredictability, and difficulty. And so far better to be prepared in advance. They say that the person who got on the top of Mount Everest didn't fall there, right? It was a climb, it was a journey, and there's hardships along the way. And in the same way, we expect there to be difficult seasons during your life, during the period that we call retirement, that impact and affect your portfolio, whether it's from within our country or without. And so today we're focused in on really what's going on in the world. But I want to tell you, first of all, as we discuss some planning principles for times of geopolitical instability, the first principle is this: Lord and Richards always has been and remains bullish on the United States. You say, what does bullish mean, Colin? I'm not a financial guy. Well, bullish means that I expect things to long-term continue to grow and move forward. Now, a lot of times you'll hear people on the radio or TV or in the media talking about whether they're bullish on this stock or that stock or bullish on the economy. And usually the focus is, quite frankly, short-term. At Lord and Richards, we couldn't be more different in our outlook. Our outlook is always long-term positivity with a paranoia in the short term, right? We know bad things can happen. We expect them to happen, but over the long run, we expect things to go well. And so we build and design your plan, your retirement freedom roadmap around this principle that we are bullish long-term, first of all, on the United States. You say, well, what about foreign stocks and the opportunities there? Sure, those opportunities are always present, and I'm all for it. We generally have exposure to global equities, stocks in our clients' portfolios and in your plan. And yet, as I compare the performance of the United States to other top economies in the world, I compare real change in gross domestic product. That means, how is our economy growing overall? Not just the performance of individual companies that may be in an index like the S&P 500 and so forth, but how does the U.S. economy stack up to other nations? Well, over the period from right before COVID, Q4 of 2019, all the way through the end of 2025, the U.S. saw growth of 14.9%. Steady, solid. Compare that to the next closest, which was Canada, 10.8, Italy, 7.1, the Eurozone as a whole, 6.8, France, 5.9, the United Kingdom, 5.2, Japan, 4.0, and Germany, a miserable 0.5% in that whole 5+ year period. So what an incredible, actually 6-year period, what an incredible contrast, right? So literally the U.S. grew almost 30 times as much as Germany in that same time period. So I continue to be, I've mentioned this multiple times, and every couple of years I'm going to remind you, put your foot forward when it comes to U.S. equity markets. We have the most favorable economy in the developing or the developed world for long-term growth of stocks, companies, businesses. That's what it really is. When you invest in a stock, you're investing in the business that stock is owned by. You become a little small owner in that large piece of the pie, kind of like Warren Buffett. That's always been his approach. It's one of the reasons he's considered the most successful investor of all time, because he always had the mentality, I'm an owner in the businesses that I buy stock. Now, sometimes he's the majority or the sole owner in those businesses, but the majority of the businesses that Warren Buffett, Charlie Munger, through Berkshire Hathaway invested in over their extensive careers were businesses where they owned a minority stake. Just like you and I do. We have this same exact opportunity. So let's go out and buy great companies in a great economic environment like the U.S. So that's the first principle during times of geopolitical stability or instability, is to be bullish on the United States. There's more reasons. When we look at just the size of the market available to you, right? When we go out shopping, a lot of times we go to these superstores if we want to get value and discounts and so forth, as opposed to the small stores where we're maybe getting a kind of an idiosyncratic item, right? Well, where is the biggest opportunity to invest? Well, in the same comparison, when I compare the U.S. to other developed countries, we have $71 trillion of market capitalization compared to our next closest competitor, Japan, at 10.7. And that works its way down through the UK, France, Canada, Germany, even China, only 4.2, Australia, Italy, and Spain at the bottom of the list at 2.0 trillion. That's the total capitalization, the size in economic capability of all the stocks and bonds in the United States compared to the rest of the world. So that's literally 7 times larger than the next closest competitor, an even stronger case to invest here. And then sometimes people will ask me, okay, Colin, well, if you're so bullish on the United States, are we in a bubble? Well, I want to come back in my next segment and answer that question for you, and why I don't believe we are, and why I don't think we need to be paranoid in the long term. We need to keep our paranoia focused on what can happen in the next month, 2 months, 3 months, 4 months, and invest accordingly. In the meantime, here's what I'd like you to do. I'd like you to grab your phone and give me a call, because I'd love to visit with you together with my team and talk to you about how you can develop a retirement freedom roadmap. This is a process that everyone goes through for free at Lord & Richards. Our planning is completely free, and we want you to be prepared for retirement. And so it just starts with a simple phone call. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400. I'd love to chat with you about how you can achieve financial independence from a biblical point of view. Or just check us out on the web at lordandrichards.com. Hi folks, Colin Richards here, and once again, I'm thrilled to be with you on this segment of the Lord and Richards Show. And in our previous segment, we were talking about why in times of geopolitical instability, I'm really bullish on the United States. And we talked about what's going on in terms of just the size of our markets, which dwarf the nearest market in the developed world. Our domestic product growth over the last 6 years compared to the rest of the developed world. And now I'm going to answer a question that sometimes people ask me, especially when the markets have been going up for a while, which they have. Now, at the time of this recording, we're down a little bit year to date, but we're still solidly up over the past year. And I get asked this question, well, Colin, are we in a bubble? I mean, what goes up must come down. You say that sometimes, and I do, right? I expect that you and I are going to experience, on average, about 3 bear markets. That's the reverse of a bull. That means we're expecting the market to go down about 3 of those per decade. Now, it can be fewer, it can be more. That's just a long-term average. So if you've got a 30-year retirement, we're expecting you to have around 9 or 10 bear markets. That's a lot, right? That's a lot to live through. And so sometimes people get a little antsy when things have been going well in the markets, and they simply say, okay, is it time to sell because I'm at a high? Well, again, timing the market is a fallacy. As people have well said, time in the market is more important than timing the market, because you got to be right on both sides. And you got to do that repeatedly, right? If we're going to have 9 of these, 10 of these over the course of your retirement, how many times are you going to get it right? Well, I'll just tell you, you're not going to win. You're just not going to win trying to time the market, predict a bubble. I sat down with somebody recently who said, yeah, I kept predicting it would drop. I just kept, reading all the doom and gloom, and it never dropped, and I missed out on all the up. I hear that all the time. And so people are so afraid of hitting the down that they miss out on the up. And we're going to talk to you about why Lord and Richards can build you a plan that accounts for that in advance, so you don't have to make emotional decisions during periods of instability, geopolitical instability, or market instability. So why is it different compared to maybe other times when we talk about the crash of 2007 to 9 or 2000? Well, one of the major reasons why I don't think we're in a bubble is because households are keeping up on their balance sheet, right? If households were just screaming in debt, if debt was out of control relative to the assets, then I think that would be a red flag and a sign that, America is headed for, a very soon coming downturn. But what has actually been happening is households' assets have been growing much faster than liabilities. I'll give you an example. In 2019, household assets were about $124.4 billion compared to liabilities of $15.4 billion. So you say, okay, well, what does that mean? Well, from 2019 till now, those assets have grown 55% to $192 billion, and yet the liabilities have only grown 28%. So almost twice as fast are we growing our assets compared to our liabilities. That's a good position to be in, right? That's a balance sheet view. Sometimes we'll just pull liabilities out all by themselves and say, oh, American household debt went from $15.4 billion to $19.7. Gloom, doom, gloom, doom. Well, no, I want to look at the net between those two, the net equity. And you've got a lot more equity today compared to just 5-6 years ago. And so I don't believe that we're in a bubble. So let's flip again to this question of geopolitical instability. The question I'm being asked now is, well, Colin, the U.S. is involved in war in the Middle East. Whether you think it's right or wrong is really beside the point. The question for today is, what will that war do to my plan? Should I be investing differently? And the answer is a solid, resounding no. Do not invest differently. Invest wisely and proactively. At Lord & Richards, we take you through a process called a retirement freedom review. And in that review, we take your current portfolio and we run it back through past wars, conflicts, and especially the down markets that most people are worried about. And so we are already predicting these are going to continue to happen. And so why would we change the plan when we fully expect things to happen as they keep happening? All right. Let me give you some real statistics that are going to help you a little bit. So you might be wondering, well, can I look to the past then and know what effect war has on people's portfolios? Sure, we can. Take the Korean War. How long did it take for people to recover? Or, the Operation Desert Storm, or let's talk about the Vietnam War, all these types of wars. Well, on average, it takes 28 days from the initial shock. So there's usually an initial drop, very typical in the short term, right? Because people are nervous and jittery and everybody wants to get out of the market. And then they realize, oh, war is actually good for the economy. We're actually selling more stuff. We hate that it's weapons, right? But we're selling more stuff, manufacturing more stuff. So it's good for the economy. It really trickles down into a lot of different areas. So 28 days is typically what it takes from the time we see the first drop until a full recovery. You say, really? 4 weeks? Yep. The longest is about 4 months, right? 5 months to recover fully. And so the shortest I saw was about 3 days to recover fully. Americans are incredibly resilient when it comes to war, apparently. It's not that it's a good thing, but I guess we've gotten used to it in some ways. And so don't you be on the fear trade, right? Don't be handing your money to somebody else. Warren Buffett, whom I love to quote, whom I've studied extensively his entire life, all the way back to his childhood, he has a comment that he's made several times. He said, the stock market is a place where, wise investors receive money from foolish investors and various variations on that, right? And so what we don't want to be is panic mode, fear mode, responding to these kinds of things. Here's what actually tends to happen over the year that follows war. On average, markets are up about 14.2%. You say up? Yep. If they're recovering within, on average, a month, then they're generally up after a war. So please don't let war and rumors of wars and the things that we as Christians expect to be going on in the world shake your strategy, right? That's the whole point. Mike Tyson, the fighter, used to say, everybody has a plan until they're punched in the face, right? Well, our plan simulates getting punched in the face. So let's not react. Let's not get reactionary, but let's stick with our plan. Understand that we're going to see down markets on a regular basis throughout your retirement years, 3 every 10 years, 9 or 10 over your retirement. Prepare in advance for that. And we're going to talk about that in our next segment. And so one last comment. People have asked me about oil, right? If you're interested in some great books, actually, I highly recommend Joel Rosenberg's Political Thrillers if you like great fiction, but he actually tends to be eerily predictive, right? And he's got a book out called The Strait of Hormuz. Well, we've seen that in the news, right? And Iran and its threats and so forth. And so people are worried about oil and it's volatile and all this kinds of things. Well, the S&P 500, when oil is up, averages an annual return of about 13.1%. That's 500 growth stocks in the U.S. When oil is down, it averages an annual return of about 11.3%. Are you hearing much difference there? 2-point difference. So let's not panic. Oil, wars, rumors of wars. Let's stick with the plan. And the most important thing is to get a plan in place right now. It's called a retirement freedom review. And we do it at no cost to you. It's an hour that will be well worth your time to know for certain that you are prepared for the retirement years. Whether you're in it or near it, we want you to sleep easy, rest easy at night, knowing that you're on track for fantastic retirement. It simply starts with a phone call. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400. I'd love to chat with you about how you can achieve financial independence from a biblical point of view. Or just check us out on the web at lordandrichards.com. Hey folks, this is Colin Richards, president and founder of Lord & Richards, and in this segment of the Lord & Richards show, we're continuing a discussion of the impact of geopolitical instability, things like wars, rapid volatile changes in oil prices as a result of wars, and what that should do for you. And we began with the principle, let's be bullish on the United States. Long term, the United States is the largest market in the world by a factor of 10 in terms of our stock and bond markets. It's growing at a faster pace and good, solid GDP growth relative to all the other developed nations in the world. It is the place to be as an investor. And don't let wars threaten or derail your plan, okay? Because frankly, wars typically result in positive returns over the year following that war or following the start of it, the onset of that. Because eventually we figure out we're producing more things, right? Oil prices. The S&P tends to be up in both down and up oil markets. So what is our best move here? You say, well, Colin, you're talking about this retirement freedom review. How is what you do different than everyone else? Well, we're specialists in getting you the income that you need. Okay, that's the first thing. So much different than saving for retirement is distributing during retirement. It's calculus, folks, versus addition and subtraction. It's not arithmetic. It is advanced math. Healthcare. It's the biggest threat to your financial future, and most people don't even realize it, and it has to do with the potential for chronic illness. We can teach you how to pay for that with other people's money. It's our specialty. And another specialty has to do with what to do during volatile markets, because what we're going to do is we're going to take principles from the world of institutional investing. Okay, this is a big world, and it's different from retiree worlds, right? In our world of institutional investing, we're talking about colleges, hospitals, endowments, foundations. They have a long-term time horizon that could be centuries. Think about Harvard with the largest educational endowment in the world. How long are they planning? Centuries. They've been around centuries. Do they have a harder job? You bet they do. But there are things that we can learn from these institutions. I share different principles every single week, so I'd encourage you to go back and check us out on YouTube or on Spotify or one of the podcast channels and get these principles. But here's something I'm going to dig into a little bit today and just leave you a nugget about institutional investing. Alternative investments tend to be the largest asset class that institutions are involved in out of all of them. Stocks, bonds, treasuries, foreign, domestic, whatever it is, alternatives. And some of those alternatives can be high risk, no doubt. But many of those alternatives are designed to improve safety. One of the things that we do at Lord & Richards is if you'll visualize a barbell, a term that I really borrowed from Morgan Housel's book, The Psychology of Money. And by the way, if you come in and visit with me, I'll give you a copy of that book. I think it's so important to understand how to invest from the standpoint of behaviors that yield to success versus failure. And one of these is the barbell. And we can teach you how on one side to get completely safe and grow on the same dollar at the same time. Okay, I'm not going to talk about that right now, but just know that that's one side of your barbell. On the other is predominantly equities, stock exposure. You say, well, what about bonds? Here's my feeling. Bonds have averaged around 4%, not the best in the world over the last 10 years. And yet during that time, we experienced a 25% drop in 2022. As a friend of mine likes to say, is the juice worth the squeeze here? 4% in exchange for a potential for a 25% drop? I don't think so. So I'm not real bullish on debt, allowing companies to borrow by way of bonds. What I am bullish on is getting yourself a piece of ownership. Instead of being a lender to a company, why don't you be an owner in that company? Like we've been talking about, get a piece of stock. And instead of just taking the pure risk, okay, on this side of the barbell, we're going to have you exposed to the stock market. Let's put some things in that are going to reduce or mitigate our risk. And hedging is a fantastic strategy. It's used by both individual and institutional investors. Institutions tend to do it at a much larger scale, and that's what we do for you as our client. So as our client, not only will we have on one side of your barbell strategies designed to completely protect you. That's the side you want to live off, right? If you're going to take income, take it off your protected side. But even on the side with risk, your growth, stock, equity portfolio, we're going to add other layers of protection that will help you stay in the market, Be worried about geopolitical instability, not worried about wars, not worried about fluctuations in the price of oil. All these things are going to come and go repeatedly throughout your retirement. Expect it to be over and over again. But what we're going to do is hedge. That means we're going to buy a special option strategy. We're going to purchase on your behalf and place within your portfolio option strategies designed to reduce your exposure to the downside. Sometimes we can take away as much as half of the downside risk while still retaining up to 65% of the upside. Do you know what that would mean for your life? To only have half the risk of the market? That's huge, folks. And we want you to benefit and participate in that. And we've been doing this for our clients for so long. It's no wonder we're A+ rated with the Better Business Bureau 5-star reviews. Our clients just don't go. They even say it. We're never going to leave. Well, folks, it all starts with a simple process we call a retirement freedom review. It's completely free to you, and it just starts by picking up the phone and giving us a call. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400. I'd love to chat with you about how you can achieve financial independence from a biblical point of view. Or just check us out on the web at lordandrichards.com.
Investment advisory services offered through Lord & Richards Wealth Management, LLC.